You know, we've highlighted how some of these real smart money managers have missed this rally in the stock market as of late. And we've often said that it's, again, one of the most hated rallies. That means that a lot of people didn't really want to believe and didn't get on board, right? So how did so many of these so-called experts get left behind? Now, if you go back to the market headlines at the time, let's go to late March, early April, it's a little easier to see why, right? The tariff uncertainty was strangulating at that time. The mainstream media was piling it on thick. They were almost reveling in the market sell-off as like an anti-Trump thing, right? And we still have a lot of our own political battles being played out daily in public here in this country, further shaking investor confidence. And last but certainly not least, there are a number of hotspots all over the world that also have investors a little bit more cautious than they might normally be. Now, I brought on my next guest to see what he has to say about all this. Please welcome to the show Mr. Craig Bolanos. Craig, thanks for coming on. Now, here's the deal. I know that you're not an active trader, right? You manage, get, stay, retired. That's your mantra, right? You manage money for people like for their
Yeah, you're right. You gotta get retired and stay retired.
Right.
And that means you need a disciplined, systematic, repeatable process that is enduring to get you through times like this.
And so what I wanted to, sometimes people get confused, but like we have people on like Adam Johnson who trades the market for a big fund and breaks it out to each individual investor, where you actually have each individual investor and you market a strategy for each individual investor. You don't have one big fund. Just wanted to make sure people understood that.
No, that's right. There's not one big fund. There's a bespoke, individually curated solution because everyone's got a different tax bracket. Everyone's got a different set of cash flow needs per month, and everyone's got a different set of resources, and everyone sees the world through different lenses.
Right.
That's what we do, and I think we do it well.
So what do you think? The story is it was probably one of the most participated as far as retail investors going, that rally, the latest one we've just had, and it's probably still continuing till today. Why do you think some of the professional money missed out on this snapback?
Well, listen, I think at the end of the day, the hard data, remember, the hard data has been surprisingly resilient.
Yes.
But what we've seen is the soft data, the sentiment. I've never seen it this bad. I've never seen it this bad. That divergence between hard data and sentiment. But for me, for our business, when I think of ISM, non-farm payroll, capital expense, less aircraft, jobless claims, all of that says the soft landing remains intact. Now, don't get me wrong, we're a little bit more vulnerable than we used to because the data has lost some momentum, but we're a long ways away from a hard landing.
And we talk about it a lot, right? In the soft data that we get and the hard data that we get for this business. And the hard data is the numbers, the true data. Soft data is surveys, feelings, right? I mean, facts versus feelings. And I will say this, you're right, that the facts or the hard data has been very resilient and actually coming in better than a lot of people thought it was going to, number one. And I think, but number two is, and we've already started to see it, some of this soft data, the feelings, the survey data, has gotten better very, very quickly because of the rally back in the stock market, right? I mean, it's funny what a 10 or 15% rally in stocks does to everybody's quote unquote feelings. And so I think that there's a lot of that. You have to be careful about getting too mired up in the soft data because soft data can change so quickly.
It can change so quickly. And listen, that's where if you want a systematic, repeatable process that's tested in the trenches, you can't do it on high frequency data or surveys, what you and I call sentiment. It needs to be on hard data. But Scott, my biggest fear, we've talked about this on your radio, we've talked about this on your TV program, is I don't want people to be too complacent here. While you hear me say the soft landing narrative remains intact, that is still probable. I can understand how it's still possible things could turn on a dime. And when you have an S&P 500, the S&P 500, not really factoring in a slowdown, that's a vulnerability, especially after this most recent rally coming off some devastating market action courtesy of the Rose Garden speech 6 weeks ago.
So if I'm smelling what you're cooking right now, you're saying that closing your eyes and buying the dips while it has worked, don't get too comfortable with that all the time because at some point in time it might not work.
Yeah, what I'm saying is here, one, I think the dips, if we have any right now, they're going to be shallower than people think. So if you're underinvested, don't be waiting for some big blow off. I don't think you're going to get it. That being said, risk and risk budgeting still matters when it comes to not just getting retired, but staying retired. And for all of those investors who came into 2025 grossly overweight in equity, maybe too much risk budget if they want to get retired, you always get a second chance to do the right thing. So look at parts of your portfolio that are all in positive territory for the year, and maybe some of those equity premiums should be coming off and finding their way into other forms of investment. I've mentioned alternative investments time and time again, in addition to certain places of the bond market, are a great place for people who want to stay wealthy right now and curb some of the excess risk out of an account.
Yeah, things are moving that way too with our budget situation and how we're handling our debt and deficits. These bond markets might get a little bit more enticing as we get a little further down this road. We'll see. As we got that 10-year flirting with 4.5%, the 30 years, I think flirting with 5% here today too. So we'll keep an eye on all that stuff. Thank you very much. You're awesome to talk to, Craig. You put it out so plainly. Even I can understand it. Appreciate you coming on the show. We'll see you again next week. Craig Bolanos, he's with VestGen Wealth Partners in Chicago. He's the co-founder and CEO. All right.